Alrighty, folks. So my friend on Discord showed me this tweet which says that Uniswap is like a short straddle. Think of the transaction volume is pushing. So we'll get to that afterwards. Uniswap is a no expiry short straddle with its break-even price, profit range, and profit percent increasing based on volume. So to explain this, we have to explain first what a short straddle is. So let's go over to Dare a bit, where we have some options we can look at. So short straddle is a. Do I have to log in here? A short straddle is an option strategy, and options are derivatives where you can buy or sell puts and calls. Combinations of doing that are called option strategies. So when you buy a put, here's our options table. You have, what do we have? Calls on the left, puts on the right. So when you buy a put, well, I guess we have to define a few terms here. So the strike price is the price of the underlying, in this case Bitcoin, at expiry. And what's expiry? Expiry is the date at which the options are exercised or expire. So let's explain those things very quick. So here's the price of Bitcoin basically now. It's somewhere between 10,450 and 10,375. And the price is indeed 10,280. So these are the strike prices. So if I was to buy, what are we looking at? On the 10th of September, if I think Bitcoin is going to be worth more than $11,000, I could buy a put. I can't because there's none available. Let's see if we can get a better table. All right, if I think the price on the 11th of September is going to be more than $11,000, I could buy which it will be. So I guess people are kind of bearish on Bitcoin. I could buy a put, which means that I'm betting that the price will go up in the time that it's active. So if I buy a put for less money, as you go up the table here, I'm saying that the price of Bitcoin will be above $10,000. That'll be exercised, and somebody will buy those Bitcoin off me at that time on the 11th of September. If I buy a call, that means that I think that a price is going to go down. So you can buy a call. Where is the price of this thing? You can buy calls more expensive as the price goes down, because that will surely end in profit, regardless of what the market does. So if the market goes down, the price goes down, that call that I bought here for $9,000 will still be in the money, or in this green here that you see, which means that I'll be exercised and I will make money on that call. So you can buy puts if the price is going to go up, and buy calls if the price is going to go down. You can also sell puts and calls. So that means that I could sell you the right to buy or the right to sell Bitcoin or the underlying at the expiry date, which means that I could sell. And in the traditional market, you could actually sell uncovered calls, which means that I could sell you the right to sell me some Bitcoin, even though I don't own the Bitcoin. I don't think you can do that on Deribit, but that's the way it works in traditional markets. If you have the account type to do that, it requires borrowing. So I can sell puts, I can sell calls. In a long straddle, which is the opposite of what this tweet suggested that Uniswap does, in a long straddle, what I do is I choose an expiry date, like the 11th of September. I choose a price, usually around very much close to these in the money here and in the money here. So if I chose 1050, 10500 rather, I would buy this put and buy this call. Basically what that's doing is the opposite of this chart that he has here. So when you're buying a long straddle, you're buying a put and a call for the same price, for the same strike price at the same expiry. And what you're doing there is you're betting that the price will move up or down by more than it costs you to buy those options. So you're betting on higher volatility with a long straddle. With a short straddle, you're doing the exact opposite. You're betting on low volatility until the time of expiry, by selling and gathering the premium. So when the maximum income from a long straddle, where I'm betting that there's going to be high volatility, is unlimited, and the maximum I could lose would be the cost of buying that put and call. If you're selling a long, if you're shorting a straddle, your maximum income is going to be the premiums or the money you make from selling that call and put, and the maximum loss is actually unlimited. So what they're saying here with this image is that when you add liquidity on Uniswap, your max profit is when the put and call strikes, when both put and call are at the same strike price, which is what you would have sold in the first place. So when you sell your put and call, you're making the premiums immediately, and the most money you could possibly make is if they don't move in price at all by the time expiry happens. Now remember again that he says that there's no expiry. So what that means is there's no chance. I mean, it's betting on low volatility, which means the price doesn't go up or down very much, and that if there's no expiry, then you don't have to be collected on for selling those puts and calls, for betting on low volatility. There's no chance that somebody's going to say, "Hey, you owe me some of that DAI or some of that DeFi or whatever that was that you added liquidity for on Uniswap." Now, the break-even point upside and break-even point downside happens when there's more volatility. So as the price goes higher and lower, there's unlimited loss potential, because you might lose the value of your ether or whatever you added liquidity with for your Uniswap liquidity pool. But as the price remains the same, your max profit remains as high as it could go. Now, what he's saying here is that when there's more volume, your break-even price, which is these points here, will go higher, and your profit percentage, which is your max profit here, goes higher, and your profit range, the distance between here and here, gets higher, gets larger as this pyramid moves upwards. So as there's more volume on the pair on Uniswap, and the price remains the same or around the same, your profits just continue to go up, and there's no expiry date, which means nobody's ever going to collect on that, and you can just leave those in there for as long as you wanted to. So as long as the price remains almost neutral, which is why a lot of these people will. Is there still a Uniswap.info? A lot of these people will put the money into like ETH DAI or ETH USDC. Here we go. Liquidity volume. It doesn't show me the returns for being in this pool. Either way, when we know that the pool is going, one of these tokens, not Ether but USDC, or not Ether but DAI, if you know that one of the tokens is going to remain around $1, it's less of a risk for you to put your money into that liquidity pool. And as the volume goes up over time, you're actually earning a percentage of the transaction fee. You're earning a proportional percentage of the transaction fee according to how much percent you own of that pool. And every time somebody trades, which is more over time, especially as Uniswap gains more traction, or there's more volatility in the markets, you earn more money for having that share of that liquidity pool. So if the price is going to remain around equal, or at least it is half as much chance for volatility in the price if you go on a stable coin pair, transactions, volume, liquidity. Well, I mean, this transaction should tell you that there's tons of fees being earned on this pair, because 0.3% of the transactions are paid out in fees. So what this tweet is saying is that if you hold liquidity and the price doesn't move very much, then over time this pyramid moves upwards, you earn more, the break-even points become higher and lower, and the distance between the break-even points becomes higher, and altogether you're doing better if there's low volatility and higher transaction volume. And what I'm saying that implies is if you have a stable coin pair, or a pair where you know one of the coins is going to remain about even in price, there's exactly half as much risk of volatility as there would be on a pair where there is higher variance in price. And you can see that over the course of these charts. So the maximum returns you could get from Uniswap, aside from prospecting on price, if you wanted the price to remain equal, you'd want to invest in stable coins, where your risk of the price is exactly half. Your risk of the price moving is exactly half. Um, and if you wanted to bet on this particular triangle benefiting you, then you would want the price to remain about the same, and you would want to benefit from being able to collect on the fees that you're having from having your liquidity in the pool, rather than prospecting on price. And that's what this person is saying about Uniswap. Thanks very much.